About chart of account considerations today. Uh, Setting up chart of account is fairly simple, but what to set up is somewhat tricky. And we'll be talking about some of the tips to help you in that process. So just to get started, about myself, I'm Yogesh Kasat. I'm one of the principals at Real Dynamics and been working on Dynamics as a solution architect and in different roles. I've written a couple of books on Dynamics, implementation guide, overall process, and as I mentioned earlier, based out of California. Um, on the right hand side, you see I was recognized as fast track recognized solution architect last year and this year 2020 as well. Little bit about Real Dynamics, and we'll get into the today's agenda. So as I mentioned, there are different ways we can be using chart of accounts or configuring chart of account. We'll be talking about some background to set the stage for today's discussion, like why are the different factors and what factors we need to consider. Legal entity planning, this is also one of the area which can save a lot of operational effort during the implementation and also set the stage for going forward as well. So that's something we'll talk about. There are, I call it selecting and eliminating financial dimension. The reason is in a lot of implementations I've been involved in or in review capacity, there is common theme where previous ERP had a certain set of financial dimensions and they end up becoming financial dimension for new ERP with few more addition. And the key thing is, even though Dynamics supports unlimited financial dimensions, you don't really want to test Dynamics. It will be really creating a challenging environment for your users if you end up with so many financial dimensions. So there are some tips we'll talk about. And then the last one will, of course, this is dynamic session. I can't just get away by showing you the presentation. So we'll go into Dynamics. We'll look at different ways to configure chart of account. And there are few, its overall setup is fairly simple, but there are few features that I would like to highlight, which kind of go hand in hand with what I talk in the rest of the presentation. And of course, we'll take questions towards end. Okay. So let's talk about the background part. So as I mentioned, it's a fairly simple process, but oftentimes it becomes the bottleneck on the projects because this area needs so many different people involvement in terms of so many different business groups, and overall processes are going to be impacted because of the way you design the chart account. And there are so many stakeholders. It's
Lost your audio. We lost your audio. I don't know if you can do anything about it.
Hello, can you hear me now? Is this better?
I can hear you again. Yes.
Okay, awesome. Sorry for technical difficulty. Okay, awesome. So we'll talk about the first portion of this, which is legal entity planning. Uh, of course, Dynamics allows you to define the legal entities. You can define separate legal entities, and you can go up to almost 10,000 legal entities, because this legal entity field is 4 characters. Of If you use alphanumeric, you can have a lot more. Usually, I have seen implementation with almost like few hundred, definitely not in thousands, but few hundred, like 700, 800 legal entities. Uh, these allowed us to create multiple legal entities. Dynamics allows you to have entity by, say, if we had a company where organization where it is 50 different countries, and you have operation in every country, and those have their localized versions and so on. That's when you go with this idea of creating separate legal entities. No brainer. The next one is other option, which oftentimes is useful to get away with less number of legal entities, which is using balancing financial dimension. Balancing financial dimension, what it does is it allows you to post inter-unit accounting, debit and credit entries, receivable and payable entries within single legal entity by creating a financial dimension that acts as a legal entity. It definitely allows to simplify the processes. If you can get away with that, it definitely is a great option. Uh, there are few examples I would call are candidates for this. For example, I was implementing a, dynamics for an entity that had a lot of real estate, and every real estate property was a legal entity for them because of liability reasons. Every legal entity had its own business setup, so that in that scenario they had around like few hundred legal entities, and all of them were here in United States, and there wasn't really need to create so many separate legal entities. We were able to get away with this financial dimension, balancing financial dimension. Same thing, another example, worked with another company where they had different funds in a way. Those are used to fund the loans and stuff like that. Those Each of those funds have their own financial statements and where its own legal entities. But from Dynamics perspective, we were able to get away with using balancing financial dimension. Okay. So we'll get into how do you decide between both the areas. So there are, I usually have customers walk through this process whenever there is a larger implementation and there are so many legal entities involved. There are two factors you need to consider. One, what are the what are my non-negotiable factors? Meaning, if any one of these criteria is not met, then you go with the legal entity route. You end up creating that entity as legal entity. And if they meet all of these criteria, then you can get away technically with the inter-unit functionality. So for example, if you have different functional currencies, one business is in Canada, one business is in US, you can't create them as inter-unit different units within same legal entity. You need to go with multiple legal entity route in that case. Fiscal calendar, if you have entity in India and United States, or within United States you have two entities came through different acquisitions, and they have different fiscal calendar that they want to follow for different reason, you are forced to go multiple legal entity route. Sales tax reporting, of course, is something you need to consider. Transfer pricing plays role. We have slide will show you if all of them are on same soil, everything else is fine, but they have certain rules for transfer pricing between the entities, then this is usually cross boundary issue, but sometimes even with other things same, like say if you have everything in Europe, EMEA region, and everything is a functional currency of Europe, but then you have transfer pricing issue, then you need to go with inter-unit functionality. And of course our favorite, localization. This definitely plays role because localizations are enabled based on the region assigned to the legal entity. Okay. Now let's talk about the other factors. Non-negotiable will let you filter out candidates that are not applicable. Now, once you have the candidates that are applicable, these are different factors you use to evaluate which option is better. For example, master data, of course, inter-unit, if it, the example I was talking about uh, earlier, for property management company, it made a lot more sense to have vendors in one entity than creating same vendor in so many different entities. Same thing with customers and so on. And that's where inter-unit made more sense in that scenario, because they were using same set of customers, same set of products, vendors, and so on. And it made things easy to maintain, and then also when they were to create new legal entities. A chart of account, not so much anymore, because it's we can use the shared chart of account. Then of course you have to consider the parameters, like you can define certain rules by legal entity in Dynamics, so we need to make sure all of them follow same so that you can continue to use inter-unit functionality. Transactions, of course, if you go inter-unit route, lot fewer transactions can be created, and then because there is lesser degree of arm's length transaction, like when you are paying from one entity to another, like say you have shared services, you have uh, one bank account that receives the money and then uh, pushes it to other entities. Things can be a lot easier if you go inter-unit functionality. Fixed asset is big one, because fixed assets, managing fixed assets in 200 legal entities can sometimes be very cumbersome. So in those scenarios, inter-unit definitely adds a lot more value. Security, you have to consider who is going to have access, and then make sure you're not going crazy with defining security just because you're now going with the inter-unit route. And last one on this list is our financial statements. Both of these approaches will let you do the reporting you need at right level. So those are good to be evaluated as well. As I mentioned earlier, this is like just arm's length transaction I was talking about between legal entities. So for example, you have operation in one legal entity who is a billing company, acts on for your customers. For example, uh, you have contracts with the customers with this US entity that only is for billing. They don't manufacture anything. But then you have sourcing companies, which are your own legal entities, maybe in different parts of the world or within United States itself. But if you have different billing companies, I've seen this applicable for different industries where you have different billing companies for different markets. Like say for government sector, you have different, because you want to protect that business. If something was to happen wrong, at least only that entity is impacted. Same thing, there are reasons why you will have billing entities by different kind of functions. And then there is in the back end sourcing company. So in this scenario, as you are looking at the, there are intercompany transactions because of the sales orders and purchase orders flowing all the way, and then it can add some work while it will help you meet the compliance you need. Okay, let's go to interesting area, the selecting financial dimension candidates. So this is really the key thing on a lot of implementation. It as it comes from CEOs and CFOs that I need this financial dimension or I need these financial reports. We really need to challenge whether we really need financial dimension to meet that requirement. Of course, we can let business decide what they want as a uh, outcome from reporting standpoint, but they shouldn't be the one dictating the solution. So a lot of times you end up with financial dimensions just because lack of subledger in legacy system or lack of trust in the subledger in legacy system. Say projects, they didn't have the project, so project was a financial dimension. Now they have lived with projects as a financial dimensions for say last 10 years. It's not going to be easy for them to think about living without that as a financial dimension. They'll throw 20 reasons why it should be a financial dimension. So you need to look at what needs to be, you need to look at it from fresh perspective and see where is the right home for this. In this, say, if you're going with project model, you're going to have all the reporting available out of project module, a sub ledger, and you don't really need to push that as a financial dimension into the general ledger in most cases. Then uh, redundant dimensions. This is also area which usually is out there, uh, say store and region. So you have stores, say customer has 50 stores and each store is assigned to a region. So if you have a store already a granular level, then you don't really need a region as a financial dimension because it's a redundant. If you already got the store, now you know which region it is. You can just put together a uh, reporting tree and then report at the regional level. And it also allows you to make sure you're not pouring concrete, meaning if store moves from one region to another, meaning store is not moving physically, but you're adding more stores, say, or you're adding more regions in the company. Say today you're small operation on West Coast, so you're saying West Coast as one region, but business grows and you're having more regional managers and you have Southern California as one region, Northern California as another region, and then Pacific Northwest as different region, then the association for those stores is going to go differently. And now if you had used financial dimension region, then all of your history is going to be tied to the financial dimension which was there at that time. So these are a few talking points or ways you can help convince the customers. The last one is on this one is too many dimensions is a first sign you should say, okay, it's not right. it adds a lot of overhead for the data entry. Even though a lot of time it comes from finance team that we need these things, but they don't realize that it's adding so much overhead. Like every time there is a journal entry, they now need to use those 6-7 dimensions uh, to on every line to make the journal entry. Or it definitely has performance impact and it makes the process cumbersome. Like now somebody is posting sales order, they have to make sure they have all those 7 things aligned. It creates ultimately a lot more work because there are so many errors that are happening because of so many different dimensions out there. Now it ends up in finance team's land at month end and they end up making so many reclass entries to fix those errors. So on one hand, you have finance team complaining that there are so many reclass entries we have to make towards end of the month. on other hand, they're the one who are pushing for getting more dimensions, which could be avoided. So let's identify key factors to define what is financial dimension. Meaning you are thrown a list of financial reports. Let's say I need P&L by store, and there are different reasons you may need a financial dimension for store, because there is gross revenue tied to store, there are SG&A, salaries and other expenses tied to store. So then it makes sense, because even though it's required for financial reporting, that doesn't mean every time it's candidate for uh, a financial dimension. You can get away with sub-ledger reporting or some other. So which leads to the next point, where do I have sub-ledger for it? A lot of times I'm asked, oh, how do I look at my project balances? How much we spent on this specific project? How much we are paying by employee location? What are my payroll costs by employee location? Now you have a payroll software or somewhere where you are maintaining the employee information and payroll. That's the right subledger for this kind of information. You don't really need to add a financial dimension just to keep track of your payroll by specific employees location. If you have so many remote employees, and now right now everybody's working from home, you're now going to look at if this is coming from a tax person anyway, they can't be using this financial data, financial statements to report on their state taxes and payroll taxes. They have to go more granular, and for right system is looking at the payroll portion. And as we talked about the store region, can this dimension be derived from another dimension? And let's see if we can eliminate that. Is it an attribute of another master data or something on the transaction? For example, a lot of times I'm asked, oh, I need a customer P&L, or I need a P&L by item group. If you can, you know the customer on the sales order, you on every invoice, meaning every revenue and COGS transaction, you have the customer associated through the sales invoice. You can just build the P&L in your Power BI. You don't need a management reporter to build that P&L or financial reporting tool to build that P&L. So there is not really a need to use customer as a financial dimension in that scenario. Same thing with the item group. Next one is related to the below gross line entry. So we talked about customer P&L. Now there are some instances where I've seen there are customer specific expenses, like, oh, we maintain this warehouse only for this customer, and we have this group only focused on this customer. And if you as a company in business where, okay, we have 3 different customers who are large enough, and all of our operations is tied to those 3 customers, and every single expense is kind of tied to the customer to large degree, then it may make sense that below gross line you have entries that are tied to the customer, and in that scenario it will definitely be valuable to have customer as a dimension. Okay. So these are just a few factors you can use to define the financial dimension. What should become financial? Let's talk about some of the considerations within Dynamics setup that you need to consider for defining those dimensions once we know what needs to be set up as dimension. So there are 3 different ways you can define a financial dimension. There is an operating unit you can use and define that operating unit as a financial dimension. There is an entity backed financial dimension, meaning you can have a customer group as a reference used for creating that financial dimension. So whenever you create new customer group, automatically that value is available as a financial dimension. And then last one is custom dimension, meaning you can just totally come up with your own list of dimension values and use those as a financial dimensions. So between these three, each one of them have the the first one, operating unit, is definitely important because you have limited set of operating units which you need to use wisely. For example, department, cost center, business unit, those are examples of operating units. They act, they play really important role in other business processes outside of just financial reporting. From workflow standpoint, organization hierarchy perspective, budgeting, and different areas. So we have to pick those wisely. Usually, if you have department, cost center, these are the really uh, one which you use as the operating units. One thing to note, financial dimensions are global values. They are not legal entity specific, meaning if you have list of departments, that is going to be same list for every legal entity. So if you have 50 legal entities, you need to streamline those across the board, which will save a lot of effort. This is easy one to do early on. Avoid leading zeros so that um, when you extract the data, finance team loves getting the data in Excel or uploading through Excel. Leading zeros will cause challenges in Excel. So it's good idea to stay away from dimension values which are 0, 0, 0 and 1 kind of. You'd better start at 1 and then add more. Smart numbering, this is also something which is a time. Implementation is the time when you want to go away from that smart numbering. A lot of times, oh, this dimension which starts with 9, the store that starts with 9 is the one on the West Coast. Guess what? 5 years from now, you grew a lot in West Coast, you'll run out of numbers. And when you define this smart numbering, it's just a human behavior to just remember those, and then your processes are going to be defined. Some of the reporting is going to be defined, and a lot more cascading effect will happen with having those smart numbers defined. It's better you keep the number as number. It definitely is a bold decision early on because they may already have some of those dependencies built, but new implementation is the time when you go away from those and factor in for those previous debts. I call them like technical debts on the from the org standpoint. Two granular values. This is an interesting one. We had a customer where they wanted too many cost centers defined. Like, oh, we want to get better visibility in financial statements with the for every cost center. The issue is if you create too many cost centers, that means there are a lot of times you're going to have very specific numbers posted to the general ledger. In one of the meeting I was involved in with CFO, he was presenting numbers and accidentally he, through his spreadsheets, he revealed one of his senior executives' salary because he was showing numbers for that one cost center where only one person was involved, and now you don't want that kind of visibility into your general ledger. Try not to have too granular cost centers, which will avoid, which will create such kind of challenges, especially when payroll and such kind of sensitive information is concerned. Um, Main accounts, this is right time to realign the numbers and then use main account categories, which will help you from financial reporting standpoint, and then make the maintenance easy there. Okay, as promised, now we'll get into Dynamics and go through some of the next tips into Dynamics. So I'm going to switch between Dynamics and presentation just to talk about what I'm showing. So I earlier in the presentation, I talked about balancing dimension for inter-unit accounting. So there are few considerations. So I have a legal entity setup where business unit is a balancing dimension. So what I had to do is also define inter-unit debit and credit, meaning due to, due from accounts, uh, and those are defined in like automatic transactions account. And another thing you have to consider is balancing dimension has to be mandatory in all the account structure you create for that entity, because if it has to be balanced, you better be able to provide the value, and it has to be mandatory. Let's go into dynamics. I hope it's still live here. Okay, so I'm going into general ledger. Under general ledger, under setup, there is ledger form. This is where you have that for that specific legal entity, where you define what are the account structure used in that legal entity and what are your specific currencies and things like that. On the same form, you can define balancing financial dimension. What this does is, the example I was talking about, property management, it will make sure every time you post the entry between two different business units, it will post the due to, due from, and keep each business unit balanced. That means you can run the financial statement at the business unit, both balance sheet and P&L, and they're going to tie. You can have a trial balance that will tie to zero. If you didn't have this, then at the business unit level, it will go out of balance, and you won't be able to produce financial statement, especially balance sheet, uh, which balances for that specific business unit. Let's go to the next tip, account structure. So avoid blank values. So this is a really important one. Like a lot of times, so in this scenario, I have certain accounts, especially say petty cash account, that needs a store as a dimension. But for rest of the accounts, I don't need store as a dimension. If you end up defining uh, store on the account structure and mark it as a blank values allowed, it kind of defeats the purpose. Now you're asking user to pick when to pick the store, and that means you are going to have a store provided even though when you're not expecting it, and then on other side it may be lost when you really wanted it. So let's go to this one. So there are two ways. So I'm going to show you the wrong way, meaning the way you shouldn't be doing it, and then we'll talk about the right way, how you can be doing it using the account structure. So I'm just going to look at my real dynamics account structure. So this one is the wrong way, the one I showed you in the presentation, where blank value for the store is allowed. However, to achieve same results based on our requirements, I'm going to define the balance sheet, and I'm going to only add business unit here as a financial dimension. And that's where I use advanced rule. So I'm going to define the advanced rule for this account structure, which says a petty cash is a mandatory dimension when account is my store is a mandatory dimension when account is petty cash. So whenever you have combination of advanced rule and account structure, advanced rule definitely wins because it's kind of in addition to what you have in the account structure. So it's always usually combination. So in this case, uh, business unit is required based on what I mentioned here on account structure, and then based on what we have mentioned in the advanced rule, it is store is required for that petty cash account. Okay, those slides. Okay, then there is a way to enforce dimension combination through. So there are two ways you can do that. org hierarchy. This is where the both of those dimensions have to be operating unit, and then you should be able to create the organization hierarchy, which will allow you to enforce the rules. For example, I have business unit as home, auto, and IT consulting practice. So let's go there. Um, so in this business unit cost center org hierarchy I have set up, so you can, it's under organization administration module, organization hierarchy. I have business unit home, and then underneath that I have these two cost centers that always work with this business unit. So whenever I have selected business unit as home, then I should only have these two values as a cost center values which are tied to this business unit. So if you want to enforce those rules, you can use the organization hierarchy to enforce those rules. And to do that, I'll go back to the account structure. So I have account structure set up here for SG&A. So under this account structure, what you do is under advanced, under setup, you define the relationship, and on relationship, you select which organization hierarchy you want to select and which part of the organization hierarchy you want to select. So if there were other components underneath business unit, you have option to say only these two I want to enforce based on this hierarchy. This list is showing me all the organization hierarchies that exist in this environment, which include business unit and cost center. So because we have business unit and cost center as required fields or a dimension which are available on this account structure, system is showing me all the hierarchies that involve both of them. Okay. Now, the benefit of this approach is if you maintain the organization hierarchy, that automatically takes care of maintaining your account structure rules. And organization hierarchy is maintained for different reasons. It also is available for you in reporting. So organization hierarchy becomes a reporting tree in management reporter or financial reporting, they call these days. Okay. Then other one, we went through this, and other ways you can use the advanced rule to define those rules that you can use. So I created the advanced rule as cost center mandatory, and then for this department, 901 department, these are the two cost centers that are applicable. If you don't have, in this scenario, I didn't have luxury to define a organization hierarchy. I was able to define advanced rule, and then this advanced rule is used on multiple account structures. That way you're still having only one place to maintain, and you can enforce those rules through advanced rules on multiple account structures. So account structure is kind of, I look at it as a basic dimensions and defining basic rules, and then as name suggests, advanced rule is like you add those exceptions on top of it using advanced rules, and it makes the maintenance lot easier. The next one is restricting main account for specific entities. So this is very important when you talk about shared chart of account across multiple legal entities. Say in France, you have certain GL accounts that are required for localization and tracking their own taxes. Same thing with India. Now, when you have global chart of account, you can use this functionality to mark those accounts inactive for specific legal entities. So in this scenario, say I'm going on main accounts form in Dynamics. So you can just search here for main accounts and open this form. And for this bank account, this is bank account for another legal entity we don't have USD bank account for Real Dynamics and USMF company. So what I've done is just added a legal entity override on this account and marked it suspended. So I can just add another legal entity override, let's say for Real Dynamics LLC, and mark that account suspended in Real Dynamics as well. So this is where you can just suspend it in all the legal entities where it should not be used. Unfortunately, you don't really have a way to say suspend it in one legal entity and say unsuspend only for specific legal entity as override. At least this was the thing last I checked. Microsoft is adding features so fast, so if it changed in latest release they just had yesterday or day before, then I may be behind. Okay. Let's go back. There is fixed dimension concept. So you have scenarios where certain accounts get used when there are things, say, for example, vendor cash discount. In my account structure, the one I have for revenue and COGS, this account for cash discount falls into that. And then on that structure, I need both item group and store to be mandatory. However, when you get the cash discount from the vendor, it's not really tied to specific item group or store, because it may be just the product you're bringing into the inventory, into the distribution center. To achieve that, you can just say it's irrelevant. Both of these are irrelevant. I just want to book them to my corporate or other values. And you can do that again using the legal entity override. So I'll go to Dynamics. Let's go search for main accounts form. Main accounts. So main accounts form. Let's search for the discount. So this is the account I'm interested in, vendor cash discount taken. So again, this was the legal entity override I created, and default dimensions defined on these are fixed values. Fixed values, the way difference is fixed value, meaning these two values will be used irrespective of what user has selected in the transaction. If journal entry is being made on this account and user selected some different values, system will ignore those values and just use these. If they are left blank, that's fine too. System will use these two values. However, the way not fixed works is this is just the way to default the value just for ease of journal entries, and system will use those as a default, but can take the values from the users if they provided something different. So those are two differences between this fixed value and not fixed value. This feature has been there since long time. It was not available in early version of Dynamics 365, and it was made available early on for sure. It's been a while since they added it to Dynamics 365 as well. Okay, with that, I will say I will open it for questions. I will leave some time for question.
Thank you, Yogesh. Excellent. Look, thank you so much for demystifying this subject matter for many. You know, a lot of the time developers are not aware. A lot of time, you know, it's an area. So thank you for sharing your expertise and demystifying that for the attendees. Once again, there are many questions and comments on this topic. So Zahir is saying, good point in customers not trusting Subledger. In 3 projects, he's built a custom reconciliation report showing GL total values matching Subledger and the total value, and they are not out of balance in trust to trust the Subledger, but it was still a fight with the finance team. It said that the ERP you can trust on it will balance it, but how do you prove it to allow trust? Do you have an approach you use to provide this trust aside from reconciliation reports? That's basically what he's asking. I don't know if that makes sense, Yogesh.
Okay, can you hear me? Sorry, myself on mute. Okay, so there is on
Sorry,
general.
did you catch that? Yeah.
Yep. So in the general ledger, so let me go back to Dynamics. So there is a setting in Dynamics that says do not allow manual entry on the any GL account. Any account that is tied to subledger, for example, AR subledger or AP subledger, you want to make sure it's activated as do not allow manual entry. That way, no direct posting can happen on this account without going through the subledger. So this is really good control in the system that you can enforce. And in addition to this, if for whatever reason it was changed by some user and some postings happen, there are definitely reconciliation reports which show you that things are matching. And I agree, it comes from, as I mentioned, it all comes from the trust that was broken in previous systems. So it's hard to convince at time, but we need to show them different ways, including this one. I just showed you what controls which are there in the system, which will prevent such things from happening.
Great stuff.
Good point.
Great
Yeah,
stuff.
thanks for calling this one out. Yeah.
So one of the questions is fin dimensions values are not LE specific. How to handle if it needs to be LE specific?
Okay. That's where you have to define those early on to see how you can do them, streamline them across the legal entities. And similar to the GL account we talked about suspending the values, you can also suspend the values in certain legal entities. So if you absolutely must have values that are not legal entity specific, you can suspend the values in the specific legal entities, so that it's just a lot of work to maintain it, but it can be done. So
Okay. So and there's a question saying here, is there any mechanism of consolidation of multiple legal entities, AR and AP, or transactions in one entity? Does that make sense, Yogesh? Tanvir, please feel free to use the microphone to elaborate.
So I'll just add to the previous question real quick. So the question was regarding the how do I define the financial dimensions entity specific. So in this demo data, of course, they are starting with leading zeros, something I don't like, but if you were to use this 001 only in specific entity, then you can just mark it as suspended in other entities and then make sure it's not used that way. Unfortunately, when I suspend this here, I cannot add another entity and mark it as unsuspended. By default, it comes as suspended. Go ahead with that question. Sorry.
Oh, yes, thanks. So the question is there any mechanism of consolidation of multiple legal entity, AR and AP, all transactions in one entity?
That's the way I would do the use the inter-unit functionality we talked about. You use one, and it really helps you in that shared services environment. But if you were truly legal entity, is different legal entities, but you have a shared services operation team that handles the AR and AP for all the legal entities. Then you have centralized payment and functionality to support the shared services operation. So even with different legal entities, you can still achieve the shared services for AR AP functions. Those are very streamlined. The one which I mentioned earlier was fixed asset. It definitely is a cumbersome process. It's not something you can do the centralized operation. So for one of my customer, we ended up creating, for whatever reason, they had to create those different legal entities, but we created one legal entity for all fixed assets. So it was just a fixed asset legal entity, which was standalone with very disconnected with other transactions, but serve the purpose of only fixed assets management, and then entries were posted back into the respective legal entities. I don't think I would do that for AR and AP though.
Okay. And there is a question related to, is there any data entity for legal entity override setup upload?
Very good question. I personally haven't looked at it, but I'm sure there is, and there is one right here. So if I look at this financial dimension value, legal entity overrides, there is entity right there. Yeah.
Okay, yep. And Saurav is saying you can use main account legal entity overrides data entity to achieve this.
Absolutely. Yep. And then there is one for financial dimensions as well.
Great stuff. Okay. So I think there's a final mention here. Is saying here, Jake Milford is saying, is there a defined list of what accounts should be set to do not allow manual entry, or to see what accounts for subledgers is set? That's Jake asking that question. Is there a defined list of accounts that should be set to do not allow manual entry?
It's actually every subledger account for which you have this true subledger. Bank, I would say, then every GL account that's connected to the bank, then there is every GL account that is connected to the AR, and because these accounts can be different. So for example, I may have 3 accounts for AR, one account for just regular AR, another account for, say, all of my deposits prepayments, which are coming through AR. And then there may be another account from just the adjustments for potential AR. So out of these 3, I would definitely potential AR debt or potential debt. So out of these 3, I'll definitely have a subledger linked on those first 2 I talked about. And then the last one is meant to be kept separate so that you can make the journal entries there and not impact the other 2 accounts which are tightly connected with the subledger. So
that's excellent, Neil. Thank you so much for clarifying this, Yogesh. A lot of people have been, you know, you've helped a lot of people to